Hey guys, welcome to the Money and Investing Show, and this week we're into the area of emotional control, how we determine the mechanics of trading versus the emotions that sit behind it. A lot of people don't want to get into trading psychology because their view is that it's way too woo-woo for them and isn't that important, just show me the support and resistance. When you go through this broadcast, you realize that the two are just as important. I'll give you 5 pitfalls to avoid and 3 action steps to ensure from a practical perspective that you stay on track and kick the investment goals that you truly deserve. Look forward to seeing you on the show. Hey there guys, welcome to the Money and Investing Show with me, your host Andrew Baxter, and as always my faithful companion and co-host Mr. Mitchell Laurential.
Faithful I am, Mr. Baxter. How are you?
Very well, sir.
That's good. Now, I've probably got the most interesting topic we've talked about ever on any broadcast.
It's cool.
And that is, I know it is, but I'm serious about this. As content director, you know I love thinking about fresh ideas. Now, we're going to take a step back from trading and hard-nosed stuff. We're going to go into a little bit of how to separate your emotions from your trading. A tough one that many people make the mistake of doing.
Indeed.
Now, I know we could go anywhere with this and it's quite loose, but what I want to start off is why most traders think about purely trading as mechanics.
Good point. So, we do a lot of work in the trading and education space, and most people, when they want to learn to trade or learn to invest more successfully, they go on this quest, whether it's books or a program or a more structured mentoring system that we operate. Most of what they want to focus on is the mechanics. How do I buy shares? How do I decide on the right shares? How do I hit the go button? Why that share versus another share, and so on and so forth, all of which are very, very important, and they're in the mechanical camp. But if you haven't at the same time built your skill set up on the emotional control, or let's call it trading psychology side of things. And trading psychology is not some sort of woo-woo area. It's critically important because it's going to affect how you apply the mechanical side. I'll give you a really simple example thinking about this now. Think about driving your car. You kind of get in, put your seatbelt on, turn the thing on, depending whether it's a manual or automatic, put your indicator on, pull off, drive down the street. Pretty straightforward. That's all the mechanical stuff when you learn to drive that you get taught. Mechanics, tick the box, happy days. But let's change the situational context of this. I'm going to have fun with this right now.
Okay.
You just had a massive fight with your partner. I mean, an absolute bell ringer. It's emotional, things were thrown, words were said, and you go storming out of the place in a huff. And you go get in your car. Now, chances are you're going to get in your car, you're going to slam the door, you're going to go turn it on, you're going to go screeching off at high revs, probably carve somebody up at the lights because you're angry and you've got all this emotion running. Now, you've been taught how to drive on the mechanical basis, just like everybody else has, but as soon as there's a heightened state of emotion involved, all of that training goes out of the window and you're just this angry person honking on the horn and carving in and out of lanes and probably going to end up having an accident. Same thing's true with trading.
You know what? I'm absolutely boiling right now thinking about this because it's so true and it makes so much sense because you get in that car and all of a sudden it's not about driving the car, you're thinking about things and you're angry and you're doing things you just wouldn't normally do. Now, when you place your first trade, as just a really basic example, when you place your first trade, your heart rate's going, there's sweat coming out of your palms, there's skin in the game, there's real money being pushed. And managing that through your whole trading career as things get a little bit more advanced or position sizes increase is paramount.
You've got to have that ability to detach yourself from emotionally and drive the car in the mechanical way that you were taught. And trading, as I say, is the same. So, a good example of that would be, let's just say you've had a bad loss on trade and you've got to get back on the horse. But that emotion of thinking, okay, I've just lost, and it doesn't matter what the number is, whether it's $200 or $200,000, people have got to work hard for their money and it means something to somebody. So what are you bringing to that next decision? It's like, I've just busted $2,000 on that last trade. This stupid market's going against me. Better get back in and try and make it back. Bet this one doesn't work either. And all of that language and all of that emotion that's brought to the equation, do you actually think you're presenting the best version of you at that decision?
Absolutely not.
When to do it? And this is where it goes wrong for people. It's a bleed over of the previous trade into the next trade, and that can snowball very badly into a really catastrophic situation where you dust yourself up, pretty badly. I've seen it happen.
Absolutely, and one of the things they actually taught me at uni that I've remembered, funnily enough, is a thing called representative bias, where your past performance on one trade is used to justify your next trade. You think about it, in reality, they've got no relation to each other. They're different businesses, different stocks, different time in the market, yet people still get them confused. What I want to ask you, and just a bit of a fun thing, a bit of a case study, what are the 5 biggest mistakes that traders make in relation to this emotional type situation?
I think that false sense of security and confidence is a huge one. And one of the approaches that we've taken with our clients, and look, depending on whether you're looking at this as a short term or long term, short term, the methodology we take with our clients costs us a lot of money commercially, but long term, it reaps huge dividends because we have people successful over the long term. What I mean by that is, we want people transacting in a small level. That means small brokerage fees, but we want them to trade small for a period of time while they build that confidence up. Why? Because it's absolutely rock solid confidence they're taking in, and as they grow, they can then start to handle a little bit more pressure, a little bit more dollars in the marketplace. I've seen other companies out there that have hit people up pretty hard, start, to go on, put in a big amount of money, and it works for them in the early terms in terms of the turnover maybe in their brokerage, but the client blows up and they've lost their confidence down the track. So getting that whole process under control right at the get-go of when you starting small is key, and not letting your confidence overshoot what your competence actually is. Sometimes, and this is a dreadful thing to say, and I'll say it on air, sometimes I almost wish that people's first trade was a losing trade. I know mine was, and I think for mine too was yours. And it gives you that heightened state of reality as to what can go wrong.
This is serious.
Whereas if you have a win, all of a sudden you're 10 feet tall and bulletproof, and we'll put more money and we've got this one by the scruff of the neck, and all of a sudden things can unravel because you haven't had a knock to have to get back up off the canvas and deal with, and haven't had that sort of psychology tested in that kind of context. So biggest mistake off the bat, people's confidence goes way past their competence. And we see this across all asset classes, not just simply in the stock market. You've got people that live in certain cities that may have bought a inner city house in the inner west for $1 million, $1.5 million. 7 years ago, it's now worth $3 million, and all of a sudden they believe they're property gurus, and it just happened to be pure luck.
Absolutely.
That they bought that suburb at the right time. But their confidence is way past that. You get somebody in the stock market that maybe gets onto a really nice trade, and all of a sudden they think that they're Warren Buffett. There is more to it than this. So confidence and competence, the first one. Second one, I think, is as you become more mature in your trading journey, to start to believe that you've got an intuition and a gut feel for markets. Trading is a mechanical process, full stop. Your job is to arrive at your trading decision in the most unemotional way you can, to be the most objective and to see it for what it is. And sometimes I think people will, after a period of time, depart from their trading plan. The trading plan is when you've got your P plates on. I'm past it. I've been doing this for 2 years now. A trading plan is the most instrumental thing you'll have day in and day out for the duration of your trading career. And the chances are, as soon as you don't have that trading plan, your trading career is over. Not because you've retired, but because you've blown your account up. I think those two things, would be the massive standouts. Number 3 is trying to be a generalist and know everything about markets. And often when people find out what I actually do, from a trading perspective, I didn't realize you're in the stock market, you trade. What do you think of this company? I don't know. And they're just like, well, aren't you supposed to be an expert on that? And it's like, no.
No, you got to carve your niche.
Yeah, but you're a trader in the stock market, so why don't you know it? So I know everything I need to know about the niche I'm in, and I don't care about anything else. That's why I get paid a lot of money for operating in my niche, because that's where I am. And so I think people often feel that they've got to learn more than is necessary, or take their knowledge much, much broader to be all things stock market. People ask me, what do you think of this IPO? I don't do IPOs. This is my thing. And so concentrate and focus. It's an interesting one. If you think about a fox and a hedgehog.
Oh, wow, okay.
Two different things. Now, a fox has got lots and lots of clever ways to avoid getting caught. A hedgehog's got one, but you try picking a hedgehog up when it doesn't want to be picked up.
You can't.
So master that niche that you have, and you'll make far more than someone that's very general. So that's the third thing I'd say, is be very, very specific as to where you operate and become very, very good at it. Experts get paid a lot of money, generalists get paid nothing. Beyond there, I think risk management is one that's missing for most people, in that they don't understand the importance of stop losses, or they think, I'll write it down that I've got to stop, but I won't put it in the marketplace. And unfortunately,
put it in.
Yeah, you've got to put it in, and put it in using the technology, the order pad that we use, and it's there, and you can forget about it. You can go to bed. You've got the peace of mind of knowing that there's a stop there that's in place. Whereas if you'd written down on a bit of paper, if ANZ hits $15, I'll get out. You turn your screen on the next day. Oh my God, it's $14.30. It'll bounce back. It'll bounce back.
It'll be
So,
okay.
Yeah,
Yeah.
let's not worry about the stop today. We'll give it time to bounce back.
We'll see what it's like tomorrow.
And then you've just made that transition from managing your money to actually managing your emotions, which are two different things. You know, you can be right or you can be rich, and not the same. This is about being objective, about managing your money, and a stop is absolutely unequivocally non-negotiable must-have. And people that are new to markets, and in fact, sometimes when people get quite experienced, again, I've outgrown stops. You'll never outgrow them. They're the most important thing in your trading arsenal. I can say that from brutal experience. This correction that we've seen over recent weeks with the coronavirus, not the first one I've been through. You know, I've traded through the GFC. I traded through the dot-com boom and bust. I traded through the European and Asian currency crisis in '98, and even when the pound dropped out of the exchange rate mechanism in the UK in '94. And so, yeah, it's not the first time I've been in these volatile conditions, and the time I did myself probably the most damage was during the dot-com boom and bust. And I remember I had some options running on the NASDAQ as it started to
Oh, wow.
away. So I was really geared into that. And so I know firsthand how expensive it can be by knowing better, because you've been doing this for a while. You must and always must continue with that trading plan, and particularly with that stop loss.
Absolutely.
And then I suppose on the other side of managing risk, the third thing is to have an exit strategy in mind.
Absolutely.
And it's funny, you sort of think to all the different experiences that you have in life, and another aspect of our business, what I do an awful lot of public speaking, as you know, and I've had the chance to speak alongside some incredible titans in that space, people like Tony Robbins, Sir Richard Branson, Robert Kiyosaki, Tony Blair, Mike Tyson. There's
Wow.
one for you. But one that was really interesting was Mark Boris. Mark's obviously famous for what he's done in the home loan space and then into Yellow Brick Road. And I remember before I met him, I didn't really understand him. I thought, I didn't know what motivated him. And I spent a bit of time in his company, and I sort of had a 180 view. And it's quite interesting when you actually talk to these people. And the great thing about being a speaker at that sort of level is that most of the core information, what the audience gets in an auditorium with 5,000 to 6,000 people in there, is fantastic stuff. But the real juice is actually in the green room out the back when all the speakers are chatting. So what are you doing in your business? And it's that, I reckon if I look back over my career, what you talk about there is probably about 8 months ahead of what goes on in the real world.
Wow.
And I remember talking to Mark in terms of business. He said the key thing before you start a business is you have to work out what your exit strategy is. Now, when you really think about it, most people are busy about logos and names and all of this sort of stuff. He's got that helicopter view, which is why he's been such a terrifically successful businessman and delivered amazing value in what he's done. And look, we don't have an affiliation with them, but it's someone I've got an enormous amount of respect for what he's done. And that notion that have your eye on what you're doing this for. What's your exit? So when you're getting into a trade, most people do their work on what am I going to buy? They don't do the work on how am I getting out? Whether
Absolutely.
that be for the stop, as we've already talked about, the stop loss, or whether it's for a profit. So I think having that game plan in play, look, if this happens, then this is my strategy, or if this happens, this is my strategy, can be quite helpful. Because if we look at an example of something like Afterpay in the recent market, and we've had clients in that, we've advised a lot of them on it too. Here's a stock that's gone from $2.50 to $41 in 2.5 years, and then down to $9 the other day, and currently at about $21 today. The volatility is bonkers. The question is, if you bought in at $2.50, when do you get out? Okay, if you got out at $5 and it's at $20, you'd be pretty upset. But you could average out, and you can sell tranches on the way out. You have to have a game plan, because if you don't and you go, I'll just hold on until I feel like selling it, you're never going to feel like selling it. And now it's been as high as $41. I can almost guarantee that you won't want to sell it for less than $41, because that's what you now believe it's worth, which is going back to what you explained from your university studies. Once you've done something, that's the outcome.
Absolutely.
That's what you expect. So now you're in a stock that's half of that price. What are you going to do? And all of that came about because you didn't have a game plan in mind. And I know this sounds so contrived, where you're sort of strategizing and you're playing chess and it's so simple.
Absolutely.
But you've got to do the work on it first before there's any of this emotion of owning the stock.
I mean, you think about it, and just to put it into layman's terms, it's like the way you describe it, which I've heard you say so many times, I'm almost sick of it, is the wet rag. It's like you've got a wet rag, you squeeze it and the water comes out. You get the easy stuff out, because the harder you have to work for it, the less you're getting. Having that profit taker there, for example, that closes you out of the trade at a level you're happy with is where it's at.
The key thing And that's exactly right. I think, the key thing that sits behind all of this, and seeing as we're talking psychology, let's get into that right now very briefly. There's something called the endowment effect. When you own something, you value it differently. So, if you think about, and for anyone listening to this podcast, you think about it, you might have a coffee cup at work that's yours, and if so, it's in the canteen, anyone can use it. But if it's yours, and if somebody else uses it, you get a bit annoyed. Maybe it's in your office and it's got some really nasty stains in it. There's probably a biohazard, but it's your thing. You like it.
Sure.
Or maybe you've got an old pair of Ugg boots at home that they're your go-tos when you want to feel really comfy around the house, and you go around in your sloppy Joe or your jogging bottoms and your Ugg boots. They make you feel good. Or maybe you've got a couple of footy jerseys, and I know you.
I've got plenty of those.
So the difference is, you see, if I put on my footy jerseys from your age, they're really tight but in all the wrong places, whereas at least yours are tight and right. But I can't throw them away because they have that sentimental value. Now, I stopped playing footy a while ago, but I still have those jerseys, and I can't imagine a circumstance where I'd want to throw them out. Now, I'm not a hugely emotional person, but they've got me. They've got me because of that emotional.
Absolutely.
Value. Trading and investing is just the same. As soon as you own something, that baggage of the endowment effect will come along, and you start to see your stock differently because you own it. And that's why it's so important to make your decisions on what you're going to get, when you're going to get in, when you're going to take profit, or if it goes wrong, where you're going to cut your loss before you start. And that's what a trading plan does.
Absolutely.
And so if you want to be successful in investing, I'm not just talking about trading, whether it's in property or whether it's in other asset classes, you have to have a plan laid out before you start. And to go back to Mark Boris, have an exit strategy in mind before you hit the go button. And it makes so much sense when you put it in that context. So, there's some of the pitfalls that I see people falling into. And the worst of it, Mitch, is they're so easily fixed. But guess what? When you want to teach someone how to invest, all they want to focus on is the mechanics, and don't worry about the woo-woo stuff in the background.
It's so prominent. And I guess, you and I spend so much time managing this stuff each and every day. I mean, how many times do we have a call from a client, should I close out of this? I mean, do I take the profit on this? It's like, take the profit.
Yeah.
Get the easy money out of there and have fun, enjoy, celebrate, pop a bottle of wine open.
Exactly right. I think so, that whole notion of backing yourself takes time to build up, and most people have got a voice on their shoulder from time to time which makes them second guess. And the whole idea, I'm not talking about being schizophrenic, but I'm just talking about that nagging conversation that you have in your mind sometimes. And the way to eliminate that, to clear that doubt, is to have a plan and be resolute in the execution of that plan. And once you've got that, all of a sudden, you're not getting in the car and screeching off and carving people up at the lights. You're driving like Miss Daisy day in and day out. And that's how you don't get points on your license. I can't comment on that. My wife certainly can, but I can't comment on that. But that's how it works. It's about emotional control, and that notion of, when we talk about the personal development space, it's not learning how to trade, it's learning how to be a good trader.
Absolutely.
Anyone can learn to trade. Simple. But can you be a good trader? And that requires that work on yourself to present the best version of you that's there.
Wow, and I'm almost feeling already more inspired, so thank you for that. Look, what I want to do is that's a great overview, and I really thank you very much for that insight. Let's put a ribbon around that, as we always do, and go into that final last couple of tips, a call to action to people who maybe have struggled with their emotional control in the past, who maybe are new to the stock market and are worrying about that. What would be your advice?
It's something that's going to be very hard to work out on your own, so tap into a support network. We've got a whole bunch of resources, and I don't mean this to turn into a plug for what we do. That's not the purpose of this, but there's a whole bunch of resources that we can certainly help people through Australian investment education or investment business, education business. There are a lot of books in this space, and I've done a lot of work with several of the people, and there's some really, really great material out there. If you look at Brett Steenberger's work, for example, if your mum and dad, that's not for you. That's for higher end people that are doing this for a living. There's some terrific stuff in there, and that Brett just has his niche, which is trading psychology, and he's probably, in my opinion, one of the best people on the planet to go to in that space. Okay. But it's not written in an accessible way. So we kind of dilute that down, as you know, and make it meat and potatoes and more practically applicable as we've kicked the can around with this. So get some skills on the emotional control and the psychological side. And that will help you with the mechanical side infinitely. Anyone can learn the mechanics. Only a select few people have that emotional control to perfectly discharge the mechanics every time. Secondly, avoid those 5 pitfalls that we talked about. So, don't let your confidence overshoot what you're doing, making sure that you always have a plan, having an exit strategy in mind before you get in, having an exit strategy for where you're going to take profit, and most importantly, being as objective as you can with that plan on the way through. They will be my big 2 takeaways for people. And don't overthink this. It's not that hard. One of the easiest and simplest things you can do is just like you've got written here is start journaling. And talk about your trades or talk about the market. And I've done a lot of one-on-one work with some very, very high-end traders on this, and this is absolutely fascinating. Some people are writers and some aren't. Go, okay, write me down, what was the decision making, and I get them to scan and send to me every day when I'm coaching them to go through and look at how they were approaching their decision making. But a better way of doing it is actually just to do a voice memo. And when you're analyzing or talking about your trade, actually record the conversation, the dialogue that you're happening, and you'll be blown away at how mad you sound when
Absolutely.
you're doing this.
You go and listen to it when you're in a non-emotional state.
Oh my goodness,
what was I
what's
thinking?
going through my mind there? And also the language and the advantage to writing it rather than typing it. A lot of people these days, everything is electronic. The advantage to writing it is that you tend to, when you type, you have a filter. You're not going to type a swear word because typically you don't type swear words. But if you're doing an audio on it, or you're just writing it down, getting that raw emotion of the swear word, this effing market or whatever it might be, it conveys exactly where your headspace was at when you made that trade. No wonder it didn't work out. But you only get that when you're unable to unlock that box of being able to get inside what was going on with someone. And we do that, as I say, with a lot of our high-end clients, we do that sort of stuff with, which is fascinating.
Absolutely. And just listening to that now, I'm going to try it myself. I've never done that. I'm going to go and record my next trade. Maybe I'll go and make one now.
Yeah, for sure. Good thing to do. And you just find that all the time it's about self-improvement, tightening the nuts and bolts, keeping focused, eliminating the fluff, but most importantly being laser precision, discharging that mechanical process with total emotional control is how you make big dollars in this game, and that's what we help people do.
Absolutely, and I think it's a notion that can either make you or break you. So AB, thank you very much. We're at the end of the broadcast. I really appreciate your advice, and there's so many good lessons out there for our viewers. So once again, absolute pleasure.
Anytime. Well, we hope you enjoyed that show. Certainly a lot of ground covered. Please do make sure you leave a review or give us a rating. It's very important to make sure that we're on point with our content. Look forward to seeing those come through.